Today, we're diving into the latest earnings season for Singapore REITs, with Sabana Industrial REIT and Keppel DC REIT both posting double-digit jumps in their distribution per unit. If you're wondering what's behind these strong numbers, why it matters for your investments, and whether S-Reits can still offer shelter from global market storms, you're in the right place. Hey friends, welcome back to the channel. I'm Iggy, and I break down everything you need to know about stocks, finance, and growing your wealth, especially here in Singapore. The investing Iguana is proud to be ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 850,000 reads and 53,000 likes. I've produced more than 800 videos, clocking over 350,000 watch hours as of February 2025. Let's get into what these latest REIT results mean for you. First, let's set the stage. S-Reits, or Singapore Real Estate Investment Trusts, are a favorite for local investors looking for steady income and some protection from the wild swings of global stock markets. This earnings season kicked off with Sabana Industrial REIT and Keppel DC REIT both reporting strong growth in their Q125 results. Sabana's DPU jumped a massive 26.5% year-on-year, while Keppel DC's DPU climbed 14.2%. These are not small numbers, and they send a powerful signal about the health of Singapore's REIT sector. So, what's driving these results? For Sabana, the story is about rising occupancy and strong rental reversions. Their portfolio occupancy improved to 86.4%, up from 8% at the end of last year. Some properties, like the Penjuru Lane cluster, saw occupancy surge from 73.7% to 86.3%. Sabana also locked in a high tenant retention rate of 99.7% and achieved a double-digit rental reversion of 15.3% for the quarter. That means they're not just filling more space, they're also able to charge higher rents, which is a sign of strong demand for industrial space. This is especially impressive given the economic uncertainties and rising costs that many landlords are facing today. Keppel DC REIT's growth story is a bit different. Their focus is on data centers, which are in hot demand as more businesses move online and need secure, reliable infrastructure. Keppel DC grew its net property income by 24.1% and gross revenue by 22.6%, thanks to new acquisitions in Singapore and Tokyo, as well as contract renewals and escalations. Their assets under management have ballooned to $5 billion over the past decade. Importantly, Keppel DC is still looking to expand, targeting markets like Japan, South Korea, and Europe. For investors, this means potential for more growth and diversification. But let's talk about the bigger picture. Why do these results matter for Singaporeans? First, S-Reits like Sabana and Keppel DC have shown they can deliver solid returns even when global markets are shaky. Their income streams are tied to real assets, factories, warehouses, data centers that people and businesses need regardless of what's happening on Wall Street. This makes them less correlated to US and global equities, offering a bit of a safe harbor for your portfolio. Second, the strong performance of these REITs could mean more stable or even rising payouts for investors. For those relying on passive income, think retirees drawing from CPF or anyone looking to supplement their salary. This is good news. Higher DPUs translate directly into more cash in your pocket. However, there are risks to keep in mind. Sabana operates in the industrial sector, which is sensitive to global trade disruptions and rising costs. Any shocks to supply chains or new tariffs could pressure their tenants and, by extension, Sabana's income. Keppel DC, while riding the data center boom, faces competition and needs to keep finding quality assets to acquire. Both REITs also have to manage their debt levels carefully, especially if interest rates move unexpectedly. How about the outlook for the rest of 2025? More than 26 other S-Reits are set to report results in the coming weeks. If Sabana and Keppel DC's numbers are anything to go by, we could see a broader recovery in the sector. In fact, S-Reits already recorded net institutional inflows in March, snapping a 5-month losing streak. That suggests big investors are regaining confidence in the sector. For Singaporean investors, the key takeaway is this. S-Reits continue to offer a compelling mix of income and resilience, especially in uncertain times. But it's crucial to look beyond the headlines, focus on occupancy trends, rental reversions, and the REIT's ability to manage costs and debt. Diversification across different types of REITs, industrial, data center, retail, can also help reduce risk. To wrap up, Sabana and Keppel DC's strong Q1 results show that Singapore's REIT sector is far from down and out. If you're looking for income, stability, and a hedge against global volatility, S-Reits deserve a close look. As always, do your homework, keep an eye on the fundamentals, and think long-term. Thanks for tuning in. If you found this analysis helpful, don't forget to like, subscribe, and share your thoughts in the comments. What do you think about the future of S-Reits? Are you adding them to your portfolio this year? Let's discuss below. Until next time, this is Iggy, signing off from the Investing Iguana. Stay curious, stay invested.